Hey guys, welcome back. In today's video, we are talking about the squeeze trigger, the share settlement, hidden short, and many more in this video. First, we're taking a look at this. Hedge funds can submit stink bids and spoofs, as Citadel has shown, at 0.0001 per share on GME, AMC, DJT, etc. But my 420.69 sale prices for GME, AMC, and DJT are rejected by Robinhood app, who paid a $45 million fine after colluding with hedge funds to remove the GME and AMC buy buttons. So one of the things that we've shown in the past is obviously the constant stink bid and spoofs that's obviously been done. And you can see this has been done by Citadel, by Virtue, by Goldman Sachs, and some others as well, obviously with the intent of dropping the price. And Citadel has discovered this and uncovered this for a very, very long time for AMC, for GME, and for many others as well. So obviously, if you guys want to take a look, feel free to visit his Twitter page, and you can see just a countless amount of proofs of the constant spoofing. But what we have to understand is why they are, of course, doing this. So the first reason for why they're spoofing is obviously because they need to push the price down. So we know that AMC is obviously a victim of that, and that's why we've never seen the real price discovery. But then it's about understanding, why don't they let us be able to obviously put our price up, put our share up at a higher price? Well, firstly, this is what we talked about with how they give an edge to the institutions. But secondly, it's about understanding that brokers are afraid for you to be able to put your price up that high, because we talked about this in the past, is that there are firms who are willing to be buying AMC shares at a very, very high price. We've seen this in the database before, where AMC shares has been traded for way above the market price. We've seen it in the hundreds, in the thousands, and again in the tens of thousands, which we have shown in the past in the actual data pool. And so that's what they're worried about, for being allowed to let retail investors obviously do that, because they understand that that will be a squeeze trigger if certain people were allowed to obviously put their share price up at an extremely high price, and then the other certain institutions were to buy it, and that obviously won't bode well, and that's why they stop us from doing it. And again, this is what we talked about with how these brokers, institutions are obviously all working together to manipulate and of course suppress the retail investors. Now, another thing is obviously understanding about they're worried for shares. And you can see this post, May 2020, relatively same times for GME. I called in my lent out GME shares. It took my brokers weeks to find my shares. I can only imagine the shitstorm in settlement now. They may have to extend delivery times. Now, I want to highlight that this was actually a tweet all the way back in Jan 29th of 2021. And this is obviously just really highlighting the situation that was back then. Now, fast forward to where we are now. We are still in the same situations, but what is different is that there are now more shares that exist out there that is, again, surpass the float that we've talked about, but we know about the settlement issues. We know when we look at the FTDs for AMC, for GME, when we look at all these unsettled shares, is that there are so much more that is out there right now. So if back then it was already this crazy, just think about what it will be now. Of course, there isn't a moment, a catalyst right now where it's the same as back in 2021, where these guys were, called in and they needed to get the shares ASAP. But what we do know is that when we get that situation again, when we get the same thing that happened back then, we are going to see an even bigger kind of just a whole thing erupt because of how many shares that's out there that can't be settled. You can even see here, breaking billion-dollar hedge fund caught naked short selling over 10 million shares, when there reportedly has an outstanding 10 million naked short shares with Nextbridge Hydrocarbons, and sought to purchase the shares back for nearly 3 million. And this is what we've seen. Now, we've seen multiple different firms with obviously naked short selling, but I want to talk about how the fact you're able to see this amount for a firm like TLP, which again was still obviously a big company, but when you compare it with GME, when you compare it with AMC, you understand that the situation, if it can be this big for MMTLP already, then just think about how big in terms of scale of things it is for AMC and for GME. And so that's what we talked about with the squeeze trigger and understanding why share settlement is extremely hard. You can also see Kristen said, enforced trade settlement, serious loophole in regulation show have perpetrated settlement failures. And so this has been obviously a serious problem for a very long time, and multiple firms have obviously seen that their share price has been impacted for this. It's also, of course, caused a massive risky problem where we are seeing how regulations are afraid that as these institutions stall to settle these shares, that the risk management is becoming bigger and bigger. And once they do have to settle or something comes up, then they will have to be paying billions of dollars, and multiple firms will go bankrupt. Multiple firms will be in debt by the hundreds of billions of dollars. And that's what they're worried about. And so this is why they're stuck in a hard place of enforcing trade settlement, but also not enforcing trade settlement, because enforcing trade settlement will obviously give a fairer market. It will get rid of the risky problem. It will prevent any risky businesses from happening. But the reason why they can't enforce it right now is because it has already been a serious problem for so long that the problems already exist. And the moment they do force them to obviously settle these trades, then all these shares in the past that they haven't settled will of course be a big problem. And so you can understand why this is such a risky situation. Another thing you can see, hit huge 3.2 million GME buy orders in after hours routed via dark pool. Of course they can let it hit lit market as there's no liquidity. Now we've just talked about share settlement, we talked about the naked short selling, we talked about the spoofing, and you can see this, and this is the reason why. It's because they want the shares of AMC, they want the shares of GME, but they can't get it. And that's why they have to do various different things. Firstly, they want to be able to buy these shares without having the price to actually go up. Hence why we're seeing large dark pool orders, because as long as it's in the dark pool, as long as it doesn't hit the lit exchange, it won't have a positive price impact. And so this is as well as just essentially no one have bought GME, but in fact they did buy GME $2.71 million worth. And this is why they constantly do this. And so you can understand what I'm saying when I say that they are in need of AMC shares, of GME shares, and it's why they don't allow us to put the price of our shares at a high price above the market price, because they know that there are people who indeed will buy these shares, and that's what they're trying to prevent. Another thing to obviously show, and I want to quickly mention, is about understanding the AMC fundamentals. We talked about this recently. We talked about the cash flow yesterday, and I just want to highlight in terms of, we talked about how, you know, they cut down theaters, but what they're doing with theaters is obviously improving, and that's what I talked about in terms of understanding how efficient their market management is, their operations are, and is why I said I'm extremely confident in AMC's future. Just wanted to quickly mention this because of what we have talked about. Now, you can also understand what's happening right now with the hidden shorts. Why is the short trigger? UBS is desperately trying to distance itself from the Credit Suisse black hole, and new capital requirements could force them to unwind risky positions at warp speed. If CS has massive hidden shorts, this could be the nuke that triggers forced buyings across the market. Hedge funds rely on those positions. They might be staring down the barrel of a full-blown liquidity crisis. Keep a close eye on GME and AMC and other heavily shorted plays. Now, if you haven't been watching these videos, you know that one of the things we've been really highlighting recently is, of course, UBS. The reason why I say this is because they inherited Credit Suisse swap positions. And in the past, when these swap positions, bankrupt Archegos, bankrupted Credit Suisse, we saw extreme price volatility with AMC and GME. And now we could be in that same situation again. But this time, what's different is that it could actually be unwinding, hence covering these positions, because we're seeing how institutions have been forced to actually close down some of their risky positions, some of their highly leveraged positions. We've seen Millennium do it, we've seen Citadel do it, and now as we see UBS inheriting these positions, we could be seeing them closing these hidden short positions of Credit Suisse that they have took, that Credit Suisse once of course had. And when we do see these cover of these positions, obviously we could be looking at the price of AMC and GME to obviously squeeze, because this is what's going to trigger it. Anyways, thanks for watching this video. I'll catch you guys next time.